Hi, everybody. Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania. It's that time of the month again. It's the first of the month update for May. What we're going to do is recap what's been going on in April, and you can see what's on every investor's mind. We are seeing the drumbeat of recession, that it's coming, or when's the Fed going to stop interest rates, or what's going on with these bank failures. So that's really been the drumbeat for the month of April. But surprisingly enough, what's been happening is that as the banking crisis fades off the news media, we're seeing that big tech earnings have really helped rally the S&P almost back to the January highs. Now, a lot of clients are asking me, how can this be, Chris? If we're facing a recession, what's going on? Why is the stock market doing so well? Well, first of all, the stock market is really being driven by big tech this year, something that hasn't happened since 2021. Because remember, in 2022, the NASDAQ was down almost 30%, and we've seen a bounce in big tech stocks. Now, why are companies going up and why is the S&P 500 and the Dow Jones rallying so far this year? It's because in the fourth quarter of 2022, many analysts lowered their earnings projections dramatically for 2023. Why? Because we had higher interest rates and a possible recession looming at some time in 2023. Well, what they're finding out is that in the first quarter so far of 2023, earnings are not all that bad. We're actually seeing sales growth, depending upon the industry, of 2, 3, 4%. We're seeing earnings beats because the bar was set so low of literally 69 to 70% of the companies reporting are actually beating earnings. So what's happening is many of the analysts are starting to crank up their earnings projections for the back half of the year. Stay tuned to see what's going to happen because, again, our thesis for 2023 is that we're in a secular fair market. Right now, I do believe we're at the top end of the range. You have to take appropriate action when you're at the top end of the range. We may be trimming some winners, raising a little bit of cash, etc., because we'll see what happens over the summer months. Because again, there's the old adage, sell in May and go away, which means basically you sell out your stock portfolio, something we wouldn't recommend, and you wait until the summer's passed, and then you reinvest back in October. There's some very good statistics with that, but again, we don't really think that's the thing to do. But in this particular case, we are at the top end of the trading range on the S&P 500. Question is, are we going to squeeze a little bit higher in the next couple of months? The other big story out there is interest rates. So again, we saw interest rates rise dramatically last year, and bond funds were down anywhere from 14 to 15%. Lo and behold, you're seeing interest rates as measured by the 10-year Treasury stabilize right around that 3.5% area. Now, if you remember, our outlook for interest rates for literally the rest of this year and into next year is that we're north or south of 3.5% on the 10-year Treasury by about 0.5%. We don't see the excitement in the bond market, which is a good thing, that we saw last year, and we think bonds are a very attractive value right now. Again, on the short end, you're able to invest in bank CDs for 1, 2, 3 months, paying right around 5%. On the long end, you've got tax-free bonds paying 4%, which are an attractive value from that standpoint. Now, why do we think interest rates are going to stay muted? We show a slide here of oil prices, and we were a big bear on oil last year. We thought oil prices were way too high, not because of potential recession, but really because so much supply had been literally pumped, no pun intended, into the system as far as both international and domestic oil production is still off the charts. Now, we've circled oil prices right now, and you see that they've been averaging somewhere between $70 and $80 a barrel for the last couple of months. They went up to the high end of the range at the end of April. Well, now for May, they're coming back to the low end of the range. Now, what does that mean as far as interest rates go? If you remember last year, everybody's big fear was that inflation was running super hot, 10, 11%, and some of it, or a large portion of it, was due to commodity prices. Well, we're beginning to see commodity prices across the board ease. The first one to drop was oil prices. If you look up a chart of wheat, corn, and soybeans, you can see that soybeans are trying to hold on to $14 a bushel. Corn's cracked below $6 a bushel, and wheat's cracked below $7 a bushel. So why is this important? All the inputs going into inflation are beginning to moderate and come down, which we believe means that the Fed will not have to continue to aggressively raise interest rates on the short end. So just to sum it up, good earnings by large cap tech stocks kept the rally that started in April alive. Again, we think that a lot of the analysts out there were way too bearish. We think companies are doing a very good job trimming the fat out there. We had a discussion with a portfolio manager the other day that back in 2021, when they couldn't get enough workers, the last 5% of workers that you hire tend to be the poorest, and they don't really add that much to the bottom line, but you just hire those people to be able to get your product out the door. What's happening right now is those people are being fired or let go. So you're seeing those last portion of workers being let go, and you hear all these companies going, hey, we're laying off 1,000, 2,000, 3,000 people. Well, guess what? Those were probably not the best employees, and they were marginal at best, and you're still seeing rather strong labor statistics out there. So again, we don't really think the recession, if it is coming, may be mild or maybe pushed off to 2024. But having said that, the 10-year Treasury is hovering right around 3.5% because fears of recession and the banking crisis are keeping interest rates muted. And our final point that we went into before is that commodity prices have pulled back, not just oil, but also the grains. And we think that's going to ease future inflation concerns. So stay tuned. This was the first of the month update for May. We'll be back next month with this update. We'll talk to you soon.